Shifts and Shocks author Martin Wolf has been a major critic of central bankers, and he lays much of the blame for the financial crisis at their feet. In the second part of our interview, I asked him to explain how money is created by banks.
They created by lending in aggregate. This was a point that actually was already clear to the very great Swedish economist more than 100 years ago, Knut Wicksell. But the banks lend, and when they make a loan, they're not lending money that's already there. They are giving somebody an advance, which is money in their account, and of course on the other side of the balance sheet, as it were, the person who gets the advance owes the bank money. So the two sides of the balance sheet work, but the advance itself is money. And why is that? Because the debts of banks, uniquely of all institutions, are transferable, therefore they're money, they're substitutes for money. And the governments of our countries even guarantee that this will be money because they have a lender of last resort called the central bank, which, if the banks run out of money, will provide it to them, provided they have reasonable collateral. So we have what I call a public-private partnership to create money, in which the banks do most of the creation as a byproduct of their lending. And of course that means that in principle, as long as people are willing to hold the money in their accounts, and in the end they usually are, that the banks can create credit without limit. And that was what Knut Wicksell noticed. And that makes the credit system incredibly elastic and in the end very fragile, because it can create panics. And that's what we saw in the fall of 2008.
And so your prescription is a bold one. Explain how you would change that, how you would solve that
well,
if you had your way.
It's one of the prescriptions. I don't believe the whole system will change overnight, but I think we have to think radically, and particularly if, as I very much fear, we might have other crises, because this system I've described is fundamentally fragile. We've known it's deeply fragile and has become more so as banks have become more leveraged. Well, the idea essentially is it goes back to the 1930s. It was called the Chicago Plan there. It was invented by some very right-wing free market economists worried exactly about what I've talked about. What they said was banks, deposit money in banks has to be backed by equivalent assets, which is essentially short-term liabilities of the government. So the maturity mismatch in the banks would disappear. And that means essentially that the government creates the money. This could be under the hands, in the control of the central bank to prevent, of course, pure inflationary finance, but essentially money per se would be created by the government. Banks could no longer make advances in the way they now do. They could only lend out money, or any institution can only lend out money that is genuinely deposited in them. So the rest of the financial sector becomes a little bit more like the shadow banking sector of before. And of course there are lots of questions about how that might be regulated. Now, my suggestion is we need an era and a time of experiment. We don't know what the best financial system is, but we know the financial system we have now is not working very well. It's very fragile, very inefficient, and it basically just leverages up property assets. This is sort of a crazy thing to do. It isn't supporting the real economy. So I want somebody to go out there and experiment with this new idea. I think that is exactly what we want to do. We don't want a one-size-fits-all global financial system. I don't expect the United States or the United Kingdom to move to such a system overnight, but this is a sort of idea that's been around now for a very long time. It has great attractions. It eliminates this extraordinary dependence we've generated on endless credit booms, one after the other, each more unstable than the last, and I think we're beginning to see the beginning of another one in the US. So this is the alternative. I want some countries to experiment with it. I think it's intellectually completely respectable and watertight. We can't know how it will work because it's never been tried, but I think we should be much more radical than we've been in thinking about finance, because it's obvious to me the system we have isn't working.
Might be the kind of thing a country like Canada could experiment with.
I'm thinking Iceland. Iceland's desperate enough.
All right.
Even a small country. Canada, yes, great.
You have some other suggestions for prescriptive ideas about how to avoid this. You are somewhat gloomy in the sense that one is left with the idea that you do think another crisis will come. But what else could we do to improve our systems to avoid that?
Well, I think there are two other ideas that are well worth considering. I'll leave aside the global macroeconomics because they're very important, but it's sort of somewhat different. One, I think we have to deleverage economies. And one of the ways for doing that, which many economists have been suggesting, is to get rid of the favorable tax treatment of debt. We provide massive incentives within our corporate tax regime and often our household tax regime to encourage people to lever themselves up. And that, I think, is completely crazy. Debt itself is a very inflexible contract. We also, at the same time, need to change a lot of the contracts. I'm a strong supporter of the idea of shared equity contracts in housing finance. What is the advantage of that? It means if house prices fall, the value of the loan automatically falls, and if house prices in general rise, the value of the loans go up. So that you share the risks with the people providing the fund. My last idea, which is not original, is that we need much more capital in the major financial institutions. Most of them are leveraged up 25 to 1. That's just not a sound system. 10 to 1 should be the maximum. If we do those three things, I think we could have a much more stable financial system. It wouldn't solve the big global macro problems, but I think it would be a system that could survive shocks. What we have now is a system that cannot survive real economic shocks.
All right, we've got seconds left, Martin, but in terms of probability of another crisis, how would you rate it?
I think it's pretty likely because everything in our system tells me, the world system, is that we need a credit boom somewhere to get the economy going, and it looks to me as though we're really trying hard to get the US back into a credit boom mode. So if we have a dynamic growth, another credit boom from where we start, we'll have another crisis, I'm sure of it.
All right, Martin, we leave it there. We appreciate your time today.
It's a great pleasure.
Martin Wolf is the author of The Shifts and the Shocks.